Hello viewers, welcome to another financial accounting class in Prof. Bittaye's online digital classroom. The topic of discussion today will be centered on financial statements. I shall first discuss the meaning of financial statements, followed by the discussion on the basic objectives of financial statements, also called advantages of financial statements. And lastly, I shall discuss the limitations of financial statements, equally called disadvantages of financial statements. What are financial statements to begin with? Financial statements are reports prepared by a business at the end of each financial year to present and summarize its financial activities. Therefore, anytime you hear or see the word financial statements, always remember it means reports prepared by a business at the end of each financial year or accounting year to present and summarize its financial activities. Financial statements provide information about revenues, incomes, expenses, assets, liabilities, and capital or equity of a business. Financial statements also give a true picture of the profitability performance and the financial position or liquidity position of a business, serving as an important tool for decision making, accountability, and planning. Financial statements generally include four main statements. Therefore, whenever you see or hear financial statements, remember that it includes four main statements. One of them is income statement, or equally called trading and profit and loss account. Income statement or trading and profit and loss account shows the revenues, incomes, and expenses of a business over a period and determines the gross profit or gross loss and the net profit or net loss of a business. The second one is balance sheet, equally called statement of financial position. Balance sheet or statement of financial position presents the assets, liabilities, and capital or equity of a business at a specific point in time, showing its financial position. The third one is cash flow statement. Cash flow statement summarizes the inflows and the outflows of cash during a period. In other words, it summarizes the cash inflows and the cash outflows during a period, divided into operating activities, investing activities, and financing activities. The fourth one is statement of changes in equity. Statement of changes in equity explains movements in the owner's equity or capital during a period, including profits retained, dividends, or additional investments. In most cases, notes to the financial statements are also included. These notes to the financial statements provide additional explanations, breakdowns, and disclosures that help readers better understand the figures in the main statements. It is important to note that financial statements show the actual financial figures of a business and are usually reviewed and verified through an audit by an auditor to make sure they are correct and reliable. Therefore, let's now discuss the basic objectives of a financial statement, or we call it basic objectives of financial statements. The basic objectives of financial statements can also be called advantages of financial statements or merits of financial statements. Financial statements are prepared to achieve several important objectives. The key advantages or merits of financial statements include: 1. Measuring business performance. They show the profit or loss made during a specific period and the cash available to the business, giving a clear picture of performance. The second objective is guiding investment decisions. They provide essential information to investors and potential shareholders, helping them decide whether to invest in the business or not. The third one is providing reliable information. They offer factual and objective data about the business, enabling users or stakeholders to make accurate forecasts, comparisons, and informed decisions. Another objective or advantages of financial statements is serving external users. They provide information to people who do not have direct access to the business records. Example: customers, creditors, suppliers, regulators, etc. But who still need reliable information to deal with the business. Another objective is taxation purposes. They help tax authorities calculate the correct amount of tax payable by the business. Another objective is also supporting auditing. They provide necessary financial information to auditors, enabling them to verify the accuracy and fairness of the business accounts. Another objective or advantage is ensuring accountability and transparency. They make management accountable to shareholders and stakeholders or users, creating trust through transparency. Another objective or advantage is facilitating loans and credit. Banks and financial institutions use financial statements to decide whether to grant loans or extend credit facilities to the business. Another objective is assisting in planning and decision making. They help management plan future operations, control costs, and allocate resources effectively. Another objective is legal and regulatory compliance. They ensure that the business complies with statutory requirements and international accounting standards. Therefore, in short, financial statements are not just records of financial activities, but also they are powerful tools that support decision making, ensure accountability, and promote the growth and sustainability of a business. Finally, let's look at the limitations of financial statements. Limitations of financial statements are equally called disadvantages of financial statements or demerits of financial statements. While financial statements provide important information about a business, they also have certain limitations or disadvantages. One of them is they cannot show future plans of a business. Financial statements cannot reveal the future strategies or plans of a business. They only reflect past and current financial performances. The next limitation is location and market factors are ignored. They do not provide information about the physical location, market conditions, or competitive advantages of the business. Another limitation is non-financial qualities are not reflected. Attributes such as skills, efficiency, or motivation of employees are not captured in the financial statements. Another limitation is limited comparability. While financial statements allow some comparisons with similar businesses, differences in accounting policies, industry practices, and reporting standards can make full comparison difficult. Another limitation or disadvantage is excludes non-financial information. Important qualitative factors such as brand reputation, customer satisfaction, or innovation are ignored because they lack a direct monetary value or financial character. Another limitation is based on historical data. Financial statements show the historical cost of assets and past transactions. They do not provide the current or fair market value of the business. Another limitation or disadvantage is it may affect accounting policies, or we can say may be affected by accounting policies instead. Different methods of depreciation, valuation, or inventory accounting can affect results, making the statements less consistent across businesses. Another limitation is limited insight into cash flow timing. While profits may be shown, financial statements may not fully reflect the timing of cash inflows and cash outflows, potentially misleading users about liquidity. Another limitation or disadvantage is risks of manipulation. Financial statements can be influenced by management judgment, estimates, or even intentional misrepresentation, which may reduce reliability. Another limitation or disadvantage is cannot measure intangible assets fully. Items like goodwill, intellectual property, or human capital are often underrepresented or excluded even if they contribute significantly to the business value. In summary, financial statements are essential tools, but users must consider their limitations and supplements, as well as to supplement them with other qualitative and market information when making decisions.